2,000, 3,000 acres. The equity went up, so now you can borrow more, relatively speaking.
Yep, what's your name?
Brett.
Brett. Good question, Brett. Yes and no. His question is, you go out and do, how do you know when you've got too much debt? You know, and that's when we come back to all these pieces of this puzzle, like I said, balance sheet and cash flow. So as long as you go and borrow that money to buy that neighboring, Cody goes and borrows that money to buy that neighboring acre. Well, that's not all due. It's not all up in his current assets that is due within the next 12 months. So the structure of your balance sheet is what a lot of times I spend time trying to balance out. Because basically if you have too much current obligations, you're illiquid. Your current ratio, meaning that we're going to take all your payments, pull up the payments for the next year into your current liabilities. So if you don't have cash flow or income generating enough to cover all those liabilities, you're illiquid, you're insolvent. Anything less than a 1-to-1, we like to shoot at a 1.5 to 1 current ratio, meaning that for every current liability, you have $1. So for every current liability dollar, you have $1.50 of current asset to pay for it. So you've already got a little cushion in there based on if grain markets are up and down, the yields are up and down. But so the structure of he borrows that typical land loan's 20 years. Cody goes out and borrows how many hundred thousands of dollars for that farm. It's paid back over 20 years. So all he needs to worry about year in and year out is his cash flow going to make that next year's payment in taxes. So it's not an easy answer, but that's where some of these other ratios, if you dig into a loan request, start to show if what's your capacity to take on that additional debt. Maybe he could afford a $200,000 loan, but he can't afford a $500,000 loan because his cash flow, the earning potential of that new asset with the rest of his farm, what income it generates, won't service that additional debt. So
I've got just kind of a follow-up to that, to Brett's question. So how do you look at valuing the items that go on this? Are we looking at, in this case, we look at purchase value? Are we looking at current market value? Are we looking at assessed value on land? Or, how do you evaluate the equipment? What are we looking at market resale? All those good kind of questions that I've heard people like you come into classes over the years, and I've heard different answers, so I'm curious how Farm Credit handles that.
And that's the first thing I was going to say is it's a bit different based on lenders and philosophies. I'd say Farm Credit compared to what I've felt with other banks, we're probably more conservative when it comes to that. The farm crisis in the 80s, your parents and grandparents all tell you about, is when people were borrowing. We're probably looking from just 6 months ago, probably across Iowa, Mike Duffy's Iowa State Land Value Survey, 15 to 20% increase in land values in the last 6 months. So it's a great question. It's $1 million question. The other thing I was going to say, only thing I'd add to their presentation here, when doing a balance sheet, we typically will do that after harvest through like March, April, prior to when you're in the field, because farmers aren't planting. Well, we'd like to do that on an annual basis at the same time relatively, so that basically a balance sheet is a snapshot in time based on this date, today for instance, of what we would value all those things at. So year in and year out on land, I don't revalue year to year land values, for instance. So that basically year in and year out, when I can show my equity change. I don't know if you guys on your 450 farm revalue land every year, or how you value your machinery. Farm Credit, unless you're coming in to buy a new farm and it's been 10 years since we upped the value, and we got a half price asset of the farm looking there, we may at that point in time update it to get it more of a real market value. But typically, And you'll see sometimes they do a cost balance sheet and or a market balance sheet. So that cost balance sheet, at whatever you purchased it for, every year will show your actual earnings, and you can track, how profitable your operation is. Then when it comes time for that big purchase, we'll look at a market balance sheet to say overall, based on today, we're not going to hold that against you, that you bought it 20 years ago and it's paid for and it's half what we value it. Machinery, on the other hand, we take, a lot of times what we'll do is I'll take a market value, and then every year I take a 10% depreciation. It's kind of a farm credit rule. Take 10% depreciation, and then we add back any purchases. So if you traded something, it would be the trade difference we add back. If it's something totally new, we add back the purchase price. So what that's doing is allowing for, on taxes, you're depreciating that thing. So on the balance sheet, it doesn't make sense. The rub is if you got an operation that's running 25-year-old equipment, just putting a bunch in repairs, fully depreciated out, after 10 years, we've got it valued at zero, but it's not really zero. So at that point, maybe we adjust it a little bit. But what that allows for is just some, that's the other thing too, that from an asset and a liability, depending on which class you have in finance or whatever, but some people would call a car or a house an asset, and I would challenge that, because an asset to me is something that produces income. So, like I said, when you get out of college, going and buying a car, you just bought a depreciating asset that costs you money whether you drive it 1 mile or 10,000. So it's one of those things that it's a double-edged sword. You need them for transportation, but as much as you can, I pay rent, I buy some cows, I try to buy land, invest in something that is going to make invest in an asset, something that's going to generate some income, and that will help you as quick as possible to start building equity. Invest in things that make you money, not. So.
Now I know you can't ever foresee the future, but I'm starting to see some of the same things they saw in the '80s. Is there a good chance that we may see what happened in the '80s again?
That's a good question. One that your fathers and grandfathers are asking a lot right now.
Yeah.
No one knows. A little bit different scenario of what we've got right now. Back in the late 70s, early 80s, the farm sector in general was very, very leveraged compared to now. I mean, right now, again, I'll reference Iowa State Land Valuation Survey Conference. Mike Duffy has every spring. I think the average age of the average landowner in Iowa is in the upper 60s. 65% or real close to there, changes every year, but more than half of all the land in Iowa is not mortgaged. It's held by our grandparents, aged people. So I look at that as saying, that's great job longevity for me, because when those next generation passes, there's going to be, I think, huge opportunity for those in this room that want to farm, whether that's livestock, whether that's grain. I think all across the board, there's huge opportunity. So the things you can do now to start building that balance sheet, start generating some income. I'll share one thing. Last year, majority of the land that's selling over the last couple of years has actually been farmers. So, the high commodity prices, good yields in general, have made the ag sector right now very, very liquid, very, very profitable. They're sitting on a lot of cash, not borrowing much on their line of credits. They're sitting on a bunch of cash sitting there ready to throw a down payment, buy a farm, maybe not even take a loan. So there's some concerns because values could drop. I mean, it's a very, very volatile market right now, but it's very, it's stabilized based on, I think, a lot of liquidity in the market, a lot of operations that are making a lot of money.